Markets rebounded last week on hopes of de-escalation in the war with Iran. We just published our second quarter investment outlook, and I want to get into that with you today. Today is Monday, April 6th, 2026. I'm Brian. I'm an investment advisor. I manage portfolios for investors like you. Let's talk market forces. Before we dive in, I want to take a moment just to address some feedback I've had from a few followers. The message I got was too much doom and gloom. I hear you, and I want to take a moment just to put some things in context. And I want to be very clear. My goal is never to provoke fear, but to provide clarity. I believe we're at the beginning of a fundamental shift in the world order when it comes to financial markets. I know hearing a bearish thesis isn't as comfortable as the everything is fine, buy the dip mantra, but my job is not to be a cheerleader for the markets. There's enough of that in the financial media. My job is to be a steward of your capital. So far, our investment strategy has been vindicated, and our performance is evidence of that. I'm not a pessimist by nature, but I am a realist. My job is to draw an accurate map of the investment environment and position your assets accordingly. Pretending the coast is clear when we're actually facing a dangerous landscape would be irresponsible. In this business, the echo chamber of consensus thinking, that's massive. There's no shortage of perma-bulls. At Alpha Rock, we think independently. We don't follow mandates. We don't blindly follow the status quo. We don't take shortcuts. We don't follow rules of thumb. We try to assess what's going on in the markets and position your capital to profit where there's opportunity and to be defensive when it's time to be defensive. I know our clients appreciate that, and that's something we will never change. Thank you for your trust and your candor. Please keep your questions and feedback coming. I appreciate it. Now let's get into the market forces. Markets rebounded last week on hopes of de-escalation, but uncertainty remains. Optimism that the Iran conflict may wind down fueled a relief rally last week, although uncertainty around a clear off-ramp and ongoing risks to the Strait of Hormuz kept volatility elevated. Stocks, gold, and Bitcoin rallied. Bonds and commodities edged higher. The S&P 500 index reached its all-time high on January 28th. Since then, financial markets and geopolitical conditions have changed dramatically. After double-digit gains in 2023, 2024, and 2025, every analyst on Wall Street was predicting that 2026 would be another positive year for stocks. As a group, analysts predicted the S&P would rise by 11% this year, driven by strong corporate earnings, lower interest rates, and strong economic growth. The prevailing narrative in January was that the tech-driven rally was broadening out into other sectors. On January 12th, we published our 2026 outlook, Bubble Watch and the Elusive Pin, where we highlighted several reasons that this year could be far more challenging for investors than analysts were expecting. As we enter the second quarter, the stock market is under pressure. Technology and software sectors have taken a steep dive. Year to date, through April 2nd, the iShares Expanded Tech Software ETF, IGV, is down 24%. The Roundhill Mag 7 ETF, ticker MAGS, is down 11.7%, and the State Street Technology ETF, XLK, is down 5.5%. Investors in broader index funds have seen more modest losses. The State Street Spider S&P 500 ETF, SPY, is down just 3.8% year to date. That's through last Friday. The war with Iran has complicated an already difficult investment environment where a number of powerful forces were already acting as a headwind to both the economy and the financial markets. Economic growth in the U.S. is slowing. The era of easy money, which drove asset prices to the most extreme levels in history, has come to an end, and the tide of liquidity is going out. The global debt supercycle is unwinding. Extreme debt levels and inflationary pressures have tied the hands of governments and central banks, reducing available monetary and fiscal policies and limiting their effects. In this stagflationary environment, asset preservation should be your primary objective. Now is not the time to be chasing returns. Your portfolio should be positioned defensively with the goal of preserving your assets and maintaining dry powder for the future. U.S. GDP, gross domestic product, slowed to 2.2% last year, and economic activity in the fourth quarter suggests that the economy is slowing further. According to the Bureau of Economic Analysis, the economy slowed to an annual growth rate of less than 1% in the fourth quarter of last year. The current slowdown is not a temporary dip. It's a structural grind lower due to the math of a deteriorating economic balance sheet. The primary driver of this stagnation is the beginning of a credit squeeze that is just beginning to tighten its grip on the economy. We're transitioning from a world of cheap, abundant credit to one where the cost of servicing debt is cannibalizing productive growth. For decades, the U.S. economy has enjoyed a virtuous cycle where falling interest rates boosted asset prices, creating a wealth effect that fueled consumption. Economic growth has been pulled forward by massive injections of borrowed money. On the global stage, the exorbitant privilege of the U.S. dollar is facing its first real friction in generations. As global central banks shift away from treasuries toward tangible assets like gold, the U.S. loses its ability to export inflation and easily finance its deficits. De-dollarization combined with elevated inflation is forcing higher borrowing costs, which is slowing growth as capital is consumed by the rising cost of goods and services. The era of easy money is over. The end of easy money is the title of our second quarter investment outlook, which we just published this afternoon. It's available to the public on our website, and then there's a link in the description. Driven not by choice but by necessity, the era of monetary dominance, where central banks independently steered the economy and controlled inflation by manipulating interest rates, has come to an end. We're now in an era of fiscal dominance, where the primary goal is managing massive government debt loads and political outcomes. The monetary escape route, which the Federal Reserve has worn out over the years, is sealed off by a combination of high inflation and rising interest rates. The Fed is stuck in a classic trap with no good choices. Cutting interest rates to boost economic growth will drive inflation to unacceptable levels, devaluing the dollar. And raising rates to fight inflation will put pressure on both the economy and financial markets. The mainstream financial media and your financial advisor will tell you the economy is resilient, stick to your plan. They'll tell you to ignore market volatility and avoid making emotional decisions. Ironically, the emotional decision is to ignore reality and pretend that an old game plan is going to work in a fundamentally changed world. Traditional investment advice isn't going to work going forward. Now is the time to adjust your portfolio. Do not wait. The unwind we've seen in the first quarter of 2026 is just the beginning of a major correction and a reordering of the global economy and the asset markets. Going forward, active management focused on preserving your assets and seeking opportunity in non-traditional asset classes will outperform a portfolio dominated by overvalued U.S. stocks. Liquidity is drying up. For nearly 2 decades, the stock market has become addicted to a steady drip of central bank stimulus and low interest rates, but the tide of liquidity is going out. Global liquidity is the hidden engine of the modern financial system. Liquidity is more than the supply of money, it's balance sheet capacity. Specifically, it's the total volume of credit and funding available to finance asset purchases and settle and refinance debt. After the great financial crisis, developed economies shifted away from growth driven by new investment to growth driven by debt financing and financial engineering. Since 2007, global debt has more than doubled to $348 trillion, and most of that debt will never be repaid. It'll be refinanced at higher interest rates. According to the Global Liquidity Index, the current cycle has reached a mature peak. After bottoming in late 2022, liquidity surged for nearly 40 months, fueling the AI boom and the record-breaking run in stocks. But now we're shifting from a speculation phase to a liquidity vacuum where the volume of money available to support high asset prices is shrinking. The elusive pin is the structural exhaustion of the debt supercycle. This year alone, advanced economies are facing a staggering 30 trillion of debt that must be refinanced. Over the next 3 years, more than $100 trillion must be rolled over at higher interest rates. These higher debt servicing costs will be a headwind to the global economy and a drain from financial markets that can't be plugged by central banks. Inflation will remain elevated. The Federal Reserve now finds itself trapped in a no-win scenario, paralyzed by the competing demands of a slowing economy and a mounting debt crisis. The importance of understanding the policy trap the Fed is faced with cannot be overstated. Eventually, the Fed will be forced into more money printing, which they will call quantitative easing or some other fancy technical name. With the federal government projected to spend well over $1 trillion on interest payments this year alone, debt service cost is no longer a manageable line item, it's a structural parasite. As the looming wall of refinancing hits, the government must issue an unprecedented amount of new debt simply to pay the interest on existing debt, creating a vicious cycle. The bond market will demand significantly higher yields to compensate for the spiraling deficit, pushing interest rates higher and slowing economic growth. History shows that central banks almost universally choose devaluation. By resuming the printing press to support the bond market and keep the government funded, the Fed may provide a temporary floor for financial markets. However, this rescue comes with a steep price of structural inflation and the sacrifice of the US dollar's purchasing power. Unlike previous iterations of quantitative easing, which occurred in a low inflation environment, printing money today amidst geopolitical conflicts, de-dollarization trends, and supply constraints will be adding fuel to the fire. Ultimately, the Fed will be forced to print money to keep the system afloat, and inflation will persist. Your portfolio should be positioned to capitalize from the continued devaluation of the US dollar. Stock market valuations remain extremely high. As we navigate this environment of slowing growth, persistent inflation, and drained liquidity, investors are facing an additional massive hurdle: the starting point of asset prices. Despite the recent pressure on the technology sector and the broader indices, the U.S. stock market remains at one of the most extreme valuation levels in financial history. When we look at the most reliable measure of market valuation, we're currently sitting at extremes that rival or surpass the speculative peaks of 1929 and 2000. Wall Street analysts frequently attempt to justify these extreme prices by pointing to forward operating earnings. However, this relies on a dangerous assumption that current record-high corporate profit margins are permanent. Historically, profit margins are highly cyclical and have been artificially inflated over the past decade by rock-bottom interest rates and massive government deficit spending. As the cost of capital remains elevated and economic growth slows, these profit margins are highly vulnerable to compression. Pricing the market based on peak earnings in an era of peak profit margins is a recipe for severe disappointment. The danger of extreme valuations is not that they predict an immediate market crash, but rather that they dictate the mathematical reality of long-term returns. Historically, the valuation metrics we see today have a near-perfect negative correlation with subsequent 10 to 12-year market performance. At current levels, the math suggests that passive investors in cap-weighted index like the S&P 500 are locking in expectations of near zero or even negative average annual returns for the next decade. The buy and hold strategy that worked well during the era of easy money is now priced for a lost decade. More immediately, these valuations create severe asymmetric downside risk. Valuations tell us about long-term returns, but investor psychology and market internals, such as the uniformity and breadth of price trends across different sectors, dictate near-term outcomes. As we noted earlier, the tech-heavy indices are already breaking down, signaling a critical shift in investor psychology from speculation to risk aversion. When risk aversion meets extreme overvaluation, the results can be brutal. A simple run-of-the-mill reversion to historical valuation norms, that's not a worst-case scenario, but a return to the long-term average, would imply a 30 to 40% decline in the S&P 500 over the completion of this market cycle. In this environment, recognizing the unprecedented risks embedded in today's market prices is the first step to protecting your wealth. If you'd like to see exactly how we're invested and why, the investment outlook we published today includes a detailed outline of our two investment strategies, Alpha Rock Growth and Alpha Rock Income, their investment objectives, and the current holdings. If you'd like to review your portfolio or discuss your investment strategy in more detail, contact me directly. Links in the description. To learn more about the Alpha Rock client experience, visit alpharockinvestments.com.